Welcome to the Stewart Wealth Quarterly Overview. I'm here with my fellow director, James Weir, to discuss what happened over the last quarter in 2024. So James, the September quarter was really quite volatile. We saw a sharp sell-off, followed by a dramatic recovery in markets. We saw central banks cutting rates, massive economic injection in China, and share markets hitting all-time highs.
There's an awful lot going on. It was a very eventful quarter. And interestingly, also, Australia, for the first time in a long, long time, was the leading return out of the various regions that we break it up into. So it beat the United States, emerging markets, and developed ex the US. Yeah.
So we saw, particularly from the yen, the carry trade, we sent out some inflation declines just to explain what happened. Maybe you might want to take us through that, James?
Yeah, it was a dramatic turn of events. In the United States, the market became convinced or concerned that the Fed would start dropping rates more quickly than anticipated because there was a fear of going into recession. And at the same time, the Bank of Japan was talking about raising interest rates. And this squeeze between the two interest rates caused the yen to appreciate, the currency. Hedge funds all over the world have been doing this thing called the yen carry trade, where they borrow in Japan at almost next to nothing, and they go and invest in growth assets and try to make a return on that. With the currency squeeze, there were all the margin calls on the loans, and they had to sell a lot of the growth assets. Massive sell-off in Japan, Europe, and in the United States. A lot of what they were invested in were the big liquid stuff like Nvidia and the tech stocks. You saw the Japanese market was down 25% from top to bottom. In the United States, it was only about 8%. But overall, it was a really good reminder. It bounced back very, very sharply. At its worst, in the United States, retail investors were just pouring in to buy the dip. Very good reminder of the volatility that can come along, and a good reminder also that don't be scared by the horses, that it bounced back very, very quickly.
So do you think it's official that interest rates have peaked?
It certainly looks that way, doesn't it? We've now had a string of central banks cutting rates. Of course, the big one over the quarter was the Federal Reserve cutting by 50 basis points, which was a chunky cut to start with. But you've also had Canada, Switzerland, Sweden, England, the EU. They've all cut rates as well. And if you look at the chart on global inflation, if you do it on a sort of a GDP weighted, you can see this very sharp downturn. We hit a peak of 8% around sort of August, September of 2022. The global rate now is down to 2.4%. In fact, there are some countries where I think central banks will be starting to get a little concerned about going into deflation or having too low a rate of inflation again, where you've seen places like Italy at 0.7%, China's only at 0.6%, France and Germany around sort of 1.5%, 1.7%. So inflation has really come down. Yes, we've definitely seen a peak. What happens in Australia will be the next one.
I suppose that's a big question about Australia. We're constantly reminded on TV about from the federal government that that's the RBA's fault. The RBA is saying, well, inflation's not low enough for them to feel that they can cut rates.
Yeah, Michelle Bullock, the relatively new governor for the Reserve Bank, has been absolutely insistent in all her speeches that the Reserve Bank is not close to cutting interest rates because inflation, she insists, is remaining a bit sticky. It's interesting. If you look at inflation, the rate of decline in inflation in Australia is not dissimilar to the rest of the world. We peaked December 22 at 8.4%. We're now down to 2.7 as of August. So it's been a relatively sharp decline. There's a very good argument to say, okay, well, when prices are changing that much month on month, instead of looking at August of 24 prices versus a year before that, maybe you look at the last 3 months or so to get a gauge of where prices are going. The last 3 months from August back was a 0.2% increase in prices, which only annualizes to 0.8%. And we're starting to see a lot of the pressures reflected in things like the national accounts, which came out during the quarter as well. Australia recorded GDP growth of 0.2 for the quarter, the lowest since the 1990s recession. And annually, it was only 1%. So Australia was at the bottom of the list when it comes to a lot of its international peers at its rate of GDP growth. Yet the Reserve Bank is saying, well, we think things are still a little overheated. In fact, it's also an interesting reminder. The media tends to treat the Reserve Bank as infallible, and they've got this sort of omnipotent ability to forecast what's going on. We got reminded during the quarter with the August Statement on Monetary Policy, where they forecast that household spending would be up 1.1%. In the national accounts, it came out at 0.5. Now, household spending accounts for about 60% of our GDP, so that's a big miss. And even the services, where they're really concerned about services inflation, in the national accounts, that was down by 0.3. So the markets, the financial markets in Australia are actually starting to price that there will be an interest rate decline in Australia before the end of this year. If we continue to get the decline in inflation combined with slower than expected retail, that may well happen.
I suppose that might also be reflected in the reporting season here in Australia with earnings, really struggling here in Australia.
Yeah. So the earnings reporting season that finished at the end of August reflected a pretty tough environment in Australia overall. There's Macquarie is now forecasting 0.1% growth for 2025. We've seen other forecasts. The highest has been about 3.5%. I think from Bell Potter. That reflects an economy that is struggling compared to some of our overseas peers. You compare the Australian earnings growth compared to some of the other international markets, and with that sort of 3-4% compared to, it's less than half of what is being forecast in places like the United States and the European Union, emerging markets, even Japan. So it underlines our recommendation where we have been underweight Australia compared to the overseas markets for some time now.
So, having said all that, the ASX 200 has had a fairly good year this year.
Yeah, it's been a spectacular run. And a lot of that up to this point has come from particularly the banks, the financial sector. Every analyst has been scratching their heads. The earnings growth for the banks has been almost non-existent. It's around 1 or 2%. And yet the market, the sector was up about sort of 40% at its most from the bottom of October last year. All that comes from what's called PE expansion. In other words, it's just positive sentiment. That's a very fragile foundation on which to build a market rally. Sentiment can change very quickly, as we've seen many, many times in the past. And interestingly, that the banks have just turned around recently with the China stimulus.
Well, just on the China stimulus, I suppose everybody's talking about it. We'll see the resources rebound quite strongly in the past week or two.
Yeah.
So when you had the Chinese economy that was really struggling with property coming under severe pressure and a lot of false starts, everyone seems to have been pleasantly surprised with the latest stimulus coming out of China.
It certainly was a real injection into markets, especially the Australian market, because it was reflected very quickly in commodity prices. The resources stocks galloped as soon as the announcement was made. It's the central bank, the China Central Bank, has come out with a very it's a program, monetary policy based program that's aimed to stimulate the broader economy and in particular property, which as you rightly mentioned has been a real drag on the economy. But they also set aside money specifically to, nudge investors to go back into the share market. And the Chinese market went up by almost 30% in the space of just over a week. And then they shut down for the week because of the Golden Week holidays. So the world will be waiting to see if there's any more where that came from that might be directed specifically into households. Hitherto, the government's been reluctant to do that, but gosh, when the government has its social contract and they're on the hook to deliver 5% GDP growth, they've got to do something.
Well, it's quite. I think I read the Chinese share market in the space of a month hit its 52-week low, or maybe even within a fortnight. Went from the 52-week low to the 52-week high.
Yeah,
So it's just
actually,
amazing.
It did it over the space of about 3 or 4 days.
Yeah.
It's amazing. Yeah.
Last quarter we spoke about the US and how US markets, equity markets were performing well. With I suppose a lot of that performance coming from maybe 20% of or a handful of companies. This quarter we've sort of seen that broaden out a bit.
It was a very refreshing change. Yes, you're dead right. So in the June quarter, we were commenting on how narrow the breadth of the market was. About 27% of companies in the second quarter beat the S&P 500 overall, but in the second quarter, it was 67%. So that means there's a whole lot more companies that are performing well in the United States. And of course, when you've got a broader foundation for a market to go up on, that means the foundation is more solid. And what's pleasing is it's not just concentrating in a handful of mega cap tech stocks. It is broadening out, and we even saw during the quarter there was a very sharp move in some of the small cap stocks, which has been a welcome change because they've certainly underperformed the large caps in the last couple of years.
Yeah, I was just reading that I think the Magnificent Seven were up about 1%, whereas the rest of the market was up about 6 to 7% over that.
That's right.
Quarter, which is good to see.
Correct. Yeah.
What about going forward? Is there anything you're expecting next quarter? Like you wrote something recently about. You may have written something recently about US election and whether that would impact the markets.
Yeah. We'll be releasing a blog article very, very soon. The election's coming up, of course, first Tuesday in November, and everyone's on tenterhooks. It looks like a very close race between the two candidates, Harris and Trump. There's a lot of consternation about what would happen should one candidate win, and do we need to take actions with portfolios. The data historically would suggest no. The best thing to do, very difficult to try to second guess exactly what the market will do as a result of almost any geopolitical event, really. And invariably the best course of action is to sit tight.
Okay, thanks a lot for that, James. You'll probably see that article in the AFR
Coming out this Wednesday.
Coming out on Wednesday. But look, thanks for joining us for the September quarter. If you've got any questions on today's presentation, feel free to give James Weir or myself a call. Thank you.